What's going on, guys? Brian's here. Today is Saturday, March 5th, 2022. Jumping right into it, let's discuss how you can increase your success rate when trading options, especially during this very volatile market environment right now. Now, if you're new to trading, as if you just started trading within the past 3 to 6 months and you're experiencing a lot of difficulty being consistent, don't feel bad. There's a lot of experienced traders that are also struggling right now. So this video, I want to introduce to you guys some key concepts using certain option spreads and how you can mitigate your risk as well as increase your probability of success. This right here is the S&P 500 or the SPY on the daily time frame, and we can see we're experiencing a pullback that's been going on right now. But more importantly, aside from the pullback, we're also experiencing a lot of very choppy price action relative to, if we look at last year, we can see there was a little bit more of a trend. We had a little bit of a healthy pullback. We had a nice trending market, a little bit of a pullback, and then a trend. Versus this year, we're having a little bit of chop, then a drop, then we bounce, a little bit of chop, then we drop, then we bounce, and then we consolidate again. So it's very difficult. On top of that, if you're an options trader, something that's very important is the VIX. Now, the VIX is calculated based on the SPX option. So the SPX is the index of the S&P 500. Without going into much detail for the VIX, we can see right here that it's the SIBO Market Volatility Index. SIBO just stands for Chicago Board of Options Exchange, if you did not know that. And one way to think of it is the implied volatility for the SPX or the SPY. So there's something called the rule of 16. So if you look at the VIX, and we see that the VIX right now is currently at 31, or we'll say $32. If you take 32 and you divide that by 16, it will give us 2. So 2 is pretty much saying that right now it's implied that the market is going to make about a 2% move either up or down almost every single day, which is very, very, very high. Now, to an option seller, they're able to sell a lot of option premium for a very high price, calls or puts. This makes it very difficult for an option buyer, because it means if you're buying a call option, which means you think the market is going to go up, you're paying a higher premium than you normally would. So let's just say you think the SPY is going to go up to, let's just say 500. And the SPY is currently trading at 430. This 500 strike call is going to be a lot more expensive because the VIX is all the way up here versus if you were buying that call with the VIX being down here. So just think of it this way. Whenever the VIX is pretty high, it means that options are more expensive, both calls and puts. It doesn't really matter. Once you're buying an option, you're paying an expensive price. Now, what makes this difficult is usually whenever the market goes up, the VIX tends to come down because there's not as much fear in the market, which is why the VIX is usually called the Fear and Volatility Index, because it's measuring fear. If the VIX drops and you're buying a call, that means your call is actually losing value because the VIX is coming down even if the market is going up. That right there makes it difficult to actually buy and hold on to calls. On top of that, if you're buying a put, usually whenever you buy a put and the VIX is pretty high, the market tends to reverse, which means you're taking on the risk of actually buying an option that has an inflated premium, and then you're taking the risk of actually being wrong on the direction. Now, in this video, I'm not going to be talking about iron condors and market neutral strategies. I'm going to show you guys how you can actually be directional with your trading, which means you're taking a bet on saying the market is going to go up or it's going to go down, but at the same time, you're not going to have to take on the same amount of risk as buying a naked option. So if we jump back to the SPY, and hopefully you guys understand that I'm trying to glaze over some topics right here very briefly in this video as either an introduction or a refresher to some of you guys. And let's jump to a little bit of the intraday time frame. And this right here, you guys know I love the volume profile. So the link to this study is in the description down below. If we jump right here, this is the same chart just with candlesticks on. So I just want to show you guys right here. This is just the volume profile. To start the week, which is usually what you want to do, you want to assess the previous week and come up with some sort of a game plan for the upcoming week. So this right here is Monday all the way until Friday. So this was this week's price action right here. Coming into this week, it was pretty easy because whenever we see this type of profile, for lack of better terms, let's just refer to this as a P profile. And I'm not using it in the traditional sense in which it means or I'm implying anything. We're just saying it's a P profile because that's the shape of the volume profile, meaning the bulk of the volume that was traded on Friday of last week was at towards the top. Whenever you see this, this is usually going to act as some sort of supply zone, especially if the market gaps down. It means once the market comes back into this zone, there's probably going to be sellers here. Now, if we think about the psychology of that for a second, as we look at the candlesticks, this right here is Friday's price action. So we can see this explosive move that came from last week, Thursday into Friday, and then the market stalls out up here, but then we gap down here. Think about any anyone that's a buyer right here last week Friday, and then you see the market gaps down. Now, if you didn't know, if you're watching this video in the future, we're dealing with a time in which Russia has just invaded Ukraine, and that's what actually happened on this time right here, and that's what spooked the market. So the market was already spooked because we're dealing with monetary policies right now. Everyone's waiting to figure out what the Feds are going to announce at the middle of March. On top of that, we're dealing with Russia invading Ukraine. So we have geopolitical news, we have a little bit of domestic news that's really affecting things, and these are not normal headlines. There's always going to be some sort of headlines that is going to affect the market, but usually whenever the Feds are talking about interest rates and things like that, it's definitely going to affect the market. It's different from some guy just going on CNBC saying like, hey, I think the market's going to pull back. These are actual events that the market is actually sensitive towards right now. So we have this supply zone right here, and why this is supply is because anyone that's a buyer here that's already taking the risk on holding a position from Friday into Monday, so over the weekend, the first thing that happens to you Monday morning is the market is down, and you're thinking about your position and you're almost regretting having bought a position. You knew you probably did the wrong thing. You're like, oh man, why did I buy calls? Why did I buy shares over the weekend? I should have just waited until Monday. So as the market comes back up into this zone right here, the first thing you're more than likely going to want to do is sell, because you're just happy because you didn't take as much of as a loss versus the people that just panic sold right at the open. So the market comes right back into this zone right here, and this is why this is more than likely going to act as supply in the future. So if we jump back and we take a look at this on the volume profile, let's actually draw it out for a second so we can go right here. So I'm going to highlight the entire value area, which is just this entire blue rectangle right here. If you want to know a little bit more about reading the volume profile, I have an entire playlist, an entire series on that. So I'll leave that description is in the link to that video is in the description down below. So I'm just going to change the opacity of this to make it a little bit easier to see. Made it red because we're saying, again, it's some sort of supply. On top of that, let's just add our volume profile. So our point of control. So let's just change this, make it gold. And again, all of this is explained in a previous videos in which I've done. But for now, we'll call this a POC. At this point, it was a virgin point of control because it had not been touched, or we'll call it a naked point of control. So whichever is your choice of preference. So at least we know what that is. So now let's turn on the candlesticks, and we can see right here. Let's go to a 5-minute time frame. This would be the market opens up down here, and the market comes into this supply zone, and we can see it pushes all the way to the top of the supply zone. But right at the very top, what do we have right here is an inverted hammer or a shooting star. More importantly, we see some sort of rejection at the top of this level. On top of that, we get a pullback to this point of control, and then we get a bounce. So we end up getting a lower high. We end up getting another inverted hammer or another shooting star, whichever way you want to call these candlesticks is not really important. So at these levels right here, we're seeing a little bit of confirmation that the market is struggling to go higher. So anywhere in this vicinity right here ends up being a valid place. And we're taking the thesis again. If you use volume profile, I'm pretty sure anybody that's watching this video has some sort of understanding of technical analysis. If you're more of a technical analysis trader, I'm pretty sure you can find maybe there was a trend line here or something like that. I was not aware of there being any type of trend line. If we were to turn on the after hours trading activities, maybe you had your own reasons or some sort of other confluence to look for a short trade right at this level or right at this level here. The day in which we're talking about right now is Monday. But again, there's multiple ways to analyze a chart. So I'm leaving traditional TA out of this video. TA just stands for technical analysis. I want to focus just on the volume profile because I think it's one of the least discretionary approaches to the market. And as a trader as myself, that's more of a quantitative trader, I like to use a little bit of more of analysis and data backing my trades. We'll get into that a little bit later in the video. But for now, just take my word for it, and assuming that this is supply because of what happened on Friday, hopefully you can follow along with the psychology behind what happens here. Again, you buy something all the way up here, it gaps down, and then it comes back up and you get a chance to break, take a no loss or a break even. You're more than likely going to take it because that's just human psychology. We want to feel a little bit better about our losing position, right? Now, taking a second, what we're actually looking at right here is the Discord in which I'm the head of for Quant Trading app right here. I'm the lead developer in Quant Trading app, but again, we'll talk about that a little bit towards the end of this video. But this right here is coming into so pre-market on Monday morning, so at 9:19 a.m. And this is right here on Monday, which was the 28th. We can see right here, so skipping over a lot of this and we just jump to this right here. On an opening drive, price will be running right into a supply zone from Friday. There's a VPOC up there and a P profile formed on Friday. So that's what we were just discussing. If we jump to this right here, this is our P profile. Pre-market, we're already aware price is down here. We're saying on the opening drive, price is likely to run straight up into this P profile where there's likely to be supply. So again, before the market has already opened, we have some sort of a game plan. I like to sit back and wait sometimes an hour or two, maybe even 3 hours before I actually open up a position, because I want as much information and data as possible. Now we can see right here, we would ideally want to see some sort of rejections on the 5 and 15-minute candles in that supply zone to look for a short trade. That's exactly what we ended up getting. If we jump here, again, here were our if we jump to here were our rejections. So we just looked at that, the inverted hammer, the shooting stars, whichever way you want to call it. And you can be reading the tape or looking for some sort of other day trading confluences or signs of a reversal. Pretty much you want to be looking at price action to determine. Now, a put calendar spread with Wednesday, Friday expirations for this week would be a nice way to have some downside protection for the week. Either you can take it as a trade, meaning you're not using it as a hedge, you're actually going to take the downside move, or you can just use it as protection because the market did look pretty strong. Either way, there was enough signs right here to show that you should put on some sort of a negative delta position. A negative delta position just means you're taking a stance on the market saying it's going to pull back. If you have a positive delta position, that means you think the market is going to go up. Now, what exactly is a put calendar spread? And this is one of my favorite options strategies for whenever I'm taking on a bearish stance or a negative delta position. I had reasons to believe, because there was enough confluence right here for myself. I'm not going to talk about some of the other confluences. We can see it in the options flow that was going into. There was an increase in the puts being purchased from since Friday of last week. So we had a little bit of confluence in the options flow. I'm using the quant trading app algo that was also showing a little bit of confluence right there regarding an intraday zone and a sell zone and things like that. But again, keeping it as simple as we're just looking at the volume profile. I was targeting 430 because 430 was a place in which there was a lot of demand on the previous levels for the profile. So 430 was always a level of interest. We can see there was a decent amount of a congestion in this zone here, and also the psychological level of whenever the market usually runs and it pulls back, it usually comes back to a 50% retracement. However, the market was showing a lot of strength, so I did not think we would just blow past 430. And then also just so you guys can see, when I mentioned the quant trading app algo, I'll actually just turn that on for a second for you guys, just so we can see what the study's on. That's what this is right here. So this is an algorithm that's generating these levels based on quantifiable information, saying where it thinks the market would be likely to bounce for this week is where it thinks it would be likely to reject for this week. So as you guys can see, it was pretty much perfect for this week right here. And it's not always going to be this accurate or this perfect, but right now the market is largely controlled by quants and algorithms, and we're not the only ones that are able to decipher this type of information before price actually gets to this level, because we actually get these zones and these levels before the week starts. So from a Sunday, we already have the levels plotted out on a chart, and we can actually come up with a game plan from before then. So let's just actually turn this off and just look at the clean price action right here. So that's why I had, if we actually look at this for a second, we can see that this would have been where it's saying the market is more than likely to stop selling off for this week. So 428 and 3/4. So targeting 430 was a very conservative as well as a realistic target. On top of that, we were targeting the Wednesday expiration for this calendar spread. This is Monday, this is Tuesday, and then this is Wednesday. It didn't need to be that long term because of the way the volatility in the market. If the VIX is really high and we've already established that the market is moving in ranges in which it normally does not move historically, we can see right here. Let's just take a look at, if we were to jump to this chart right here, and let's see what's the range on this. So about a 1.5% move from here to here. We have almost a 2.2% move from here to here. We have a 1.6% move from here to here. We have a scroll down. So from here to here, we have a 1.2% move, and then obviously this day has a super wide range here coming from here to here. We have about a 2.6% move. So the average of this right now, and again, we're using the VIX at where it's closed at on Friday. On average, it's saying about a 2%. That's if you're using the rule of 16 for the VIX, and then you're taking the VIX divided by 16, and then using that number as a gauge for how much the options market is pricing in the VIX is moving. So we can see these types of range. So if we're targeting some sort of a pullback, and we want to say, okay, the pullback is at 430 from that level, that's within a 2%. So it's very realistic that the SPY will come back to this level within a day or two. We actually don't need to buy puts that are that far out. On top of that, we can see the extended move in which it just made. It's going to be harder for it to actually keep going up. So more than likely, there's different scenarios. If you trade naked options, your choices are very binary. That means either it goes up or it goes down. But the beauty of options is you have a lot of ways in which you can structure your trades where you make money in multiple scenarios, as opposed to just up or down. You can say you want to make money if it's it's going to go down. You're going to make money if it stays sideways. You're going to make money if implied volatility increases. These are three cases right here in which you can enter a trade using options and profit off of any of these scenarios. This is why I like the put calendar spread, because the put calendar spread has a negative delta position. The symbol for delta is this sign right here, but I'll just use the D for delta. And then it has a positive theta position, which means it benefits from the passage of time. This is our delta right here. And then it also has a positive vega position, which means it benefits when implied volatility goes up. That's what we're experiencing right now in the market. So if we actually jump back to the VIX, we can see from Monday right here, we had an explosive increase in implied volatility. This is good if you are long options, which means if you're an option buyer. But if you're a put buyer, it's very good for you, because the reason the VIX goes up is because price is pulling back. Now, before we continue on the chart, I actually want to introduce to you guys OptionStrat.com. So OptionStrat is a tool in which I use, and I think they're amazing. So let's just say we were to mock up a calendar put spread. I've done videos on calendar spreads, and I don't want to explain exactly the mechanics of how these things work. But let's just say you were to run a calendar spread on the SPY because you were bearish, and you think the market is going to pull back to we'll say 420 right now, right? So where the SPY is currently at is 432. And let's just say you're running a calendar spread. A calendar spread means you are shorting a shorter term contract and you're buying a longer term one, because the theta affects the shorter term contract faster than it affects the longer term one, and that's what creates the positive theta position. So as we look at the Greeks right here, OptionStrat is actually multiplying the Greeks by 100, so it's making it easier for us to actually see. What this is saying, it's a negative delta. Again, think of it this way. D is for direction, T is for time, and V is for volatility. So direction, time, volatility is delta, theta, and vega. If your delta is negative, that means your position is going to benefit as the market is pulling back, or as your stock or your underlying is pulling back. In this case, we're talking about the SPY, so having a negative delta position is good. What's always happening with options is that time is always passing by. So having a positive theta means you don't need to worry about it taking too long to actually pull back. On top of that, having a positive vega is good because implied volatility jumps as something is pulling back also. So what we're seeing right here is the increase in the profitability for this spread. Now, when you run these types of spreading, you're using some sort of risk analysis or some sort of calculator to decipher your profits. Know that the Greeks change depending on as price is moving. More importantly, volatility is going to change, and we know time is always affecting the option. What this is saying right here is this is our net debit. So that means in order to buy one of these, it's going to cost us $5.40. Or $540 to buy one. Because it's a debit spread, the max you can lose is how much you put in. Now, what this is showing is at the day of expiration. So that's if you held this spread for 14 days. But you don't need to be in the trade to 14 days to profit. It's the same way if you bought a naked put. Let's just say you were to buy a put that expires at the end of the month. You don't need to hold it for the end of the month. Maybe you just think the market is going to pull back for a couple days. You might just want to hold it for a couple hours, if anything. So if we look at this right here, you can drag this down and say, let's just see where this spread will be, call it mid this week. So this upcoming Wednesday, the spread will be up about $100. If you press this right here, we can actually see that that's about 20% of the spread. However, if the market was to go up, let's see how much you'll actually be down. So about $40. So this right here is showing you can kind of evaluate your risk reward. Again, the Greeks would change. If the market goes up, implied volatility will more than likely come down. So that would actually hurt a calendar spread. But if you're right on the direction and the market actually does go back this week and implied volatility increases and it comes to actually your strike price, which is 410, you'll actually end up getting a very nice return by being in something like this, and it actually makes it a lot safer to swing. So I actually want to demonstrate that on a chart for you guys. I'm going to show you some real live examples as well as the trade in which I actually took this trade, so you guys will be able to see the calendar spread and how it operates in terms of the P&L. So this right here is the 430 put that actually expired on Wednesday. So let's just say we can see the market actually ended up closing at 430 on Tuesday. So we ended up being right on the direction. And this right here is the time frame in which we entered the trade. Now, we're not always going to have perfect execution like this, but in this case, we ended up being able to catch the trade at the exact bottom. As we actually jump back to the Discord, as we scroll to the top of the commentary. So starting off by looking at the ES, blah, 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 blah. Let's just see. So this was the commentary in which price ended up getting rejected. We had a little bit of the pullback. So as we continue along, again, this is more of the confluence in which I was talking about right here. And this is, again, just using traditional TA. We can see this going here. We could see on the SPY, I'm always looking at the SPY and the futures just because the futures is a cleaner continuous price action since they trade almost 24/6. And what we're seeing right here is pre-market on Tuesday as the SPY was continuing to bounce back up. Now, if you were to be in naked puts and you decided to buy this put right here because you're targeting 430 for, Wednesday. So this is our entry right here and you're targeting 430. The market opens up right here. So even though so far the market has gapped down, assuming you didn't take the profits on the day trade because you're swinging for a bigger move or you're looking for a bigger move, this is your profits for the same day, which is an excellent for a day trade. But as someone that's holding the trade, if your entry is $2 and the next day it's right back to $2, that's very frustrating because the first thing you see as the market is rallying into the open, you get nervous and you actually end up closing the trade, and you end up realizing later that if you just held, you would have hit your profit target. More importantly, if you hold until expiration on this trade, you end up losing all of your profits because it's an option that expires so soon. But in this case, it worked out for us again because we had really good entry and we were right on the direction right away. If you've been trading long enough, you know that doesn't always happen. So let's actually jump over to, this is the P&L for a calendar spread. And to make things a little bit cleaner, I'm actually just going to change the style of the chart and put it on just an area graph. And we can see right here how the P&L moves for this. So the entry at the same time was $1.87. And by the time we were able to hold this, you see on Tuesday, the next day, it actually opened up right here. So we remained in the green, and then it continued to increase in profits all day. And we were able to hold this into Wednesday. So I was able to scale out. So took a third off the next morning because we were already up, took some risk off, took another third off once we actually hit 430 for our target, and then held the last piece for the following day and actually took profit right around here. Jumping back to the Discord, we can see that right here. So the SPY calendar expires tomorrow. So this is Tuesday, already up 30%, already taking a third of the position, looking to close another 1/3 later today. And as the market continued to sell off, we can see that we're now at our profit target area, which was 430. So just saying it's time to take another third off and so forth. At the same time, I open up another calendar, but we're going to talk about that in a second. This is also what I was just demonstrating. Again, as I mentioned to you guys, how put calendars benefit whenever the market's pulling back because it's negative delta, it's positive theta, and it's positive vega. If we jump back to this chart, you guys can see how clean and smooth this P&L curve is in relation to, if we look at the naked option, this thing is jumping all over the place, up and down, and ultimately expires worthless. This is a case again in which things actually worked out for us. Now let's actually look at a chart, the QQQ, and look at an instance in which we were right on the direction but wrong on the timing. And the QQQ, which is the ETF for the NASDAQ, what we're looking at right here is this is the same price action, similar to the SPY. So this would be Friday, but we can see it wasn't as extended. So the price did push a little bit higher. And we can see this is a little bit more choppier than the SPY this week. However, on this day right here on Tuesday, as we were taking profit on the SPY, I had mentioned to members in the Discord that I wanted to open up a put position for the Qs targeting 435 for Friday. Now, as you guys can see, we ended up getting this profit target hit almost to the tick right here, which is just beautiful. But pay attention to the path of the road in which it took to get there. So again, this is Tuesday. We entered this trade right here, and we were actually wrong on the direction immediately, but then ultimately price came right back down to our target. If we were in naked puts, we would have been destroyed on a move like this, and that's what we're actually going to take a look at. And as I pull it down, this is exactly as we just said. So just open some of these QQQ put calendar spreads. This is where the Qs were. So at 343, we'll say, and targeting 335. Why? Again, this is where the quant trading app algorithm was saying that this is more than likely where the Qs would have been bought up for this week. As we jump to the chart and actually take a look, you guys can see it came right down to where the algo was in a sense saying, and this level held as a double bottom here on Friday. So we end up hitting our profit target, but the path in which it took to get there was not so smooth. So as we're looking at this right here, let's jump over to the same thing. Let's pull up the Qs and let's mark on the chart where our entry was, which was, we'll say right about here. So there's our entry, again, targeting this level right here. So I'll actually mark it on the charts for edit. We'll go 335 because that was our strike price. Make it pretty bold right there. So we know this is exactly where we're targeting. Hit the target to the T. Now let's pull up the 335 put for that day for Friday expiration, and then let's actually just adjust the Let's actually just adjust the style and let's put it back on candlesticks, because this is what we're used to trading off of. And this is essentially where our entry was. So the entry, if you were to buy this, would be $3.20, which means it's costing you $320, right? Couple days later on Friday, when we finally hit our target, this is it right here. This contract is going for $1.70, which means you would have lost $150 per contract that purchased, or you would be down negative 45%. That's if you would actually hit your target. Now imagine just by the next day buying this here, if you were still holding, you're down 82%, over 80% right here. More than likely, any person is just going to stop out here. You're just going to close this trade because you'll be upset just from here to here, knowing that overnight you're down 20, 25, 20, almost 30%. Just actually, we opened all the way down here. So you're down 40% overnight, even though you know more than likely, because of what's going on in the world, your confluences, your technical analysis, your indicators, your algorithms, you have all the signs saying this is where the NASDAQ is going. But for whatever reason, you decide to buy a put, and you still end up losing money. There's nothing more frustrating than when you're trading options and losing money, even though you're right on where price is going. This is going to constantly happen to you if you're trading naked options, especially if you're swinging naked options, especially when the VIX is so high, because you have so many things going against you. What happened the next day is, as the market continued to go up on Wednesday, we took a look at the VIX chart earlier. The VIX actually was dropping. That's what was hurting these options. On top of that, time passed by between here and here. Time was also killing this option. And then on top of that, you had a negative delta position because you were bearish on the Qs, or anybody taking this trade was bearish on the Qs, and that actually was also killing the position. So those are three Greeks destroying this option, even though at the end of the week, you were actually right on the direction. Now, if you're someone that's been trading, you say, like, well, that's why I don't trade naked weekly options, or I don't swing those because it's too risky. I go further out. So now let's take a look at, this would be the monthly contract, so 15 days till expiration. And at the same time, this contract's going for $8.10. So now you're talking about putting $810 per contract. So if you buy 10 of these, you already have $8,000 in the market. And the next day, this ends up happening to you. And the max drawdown for this position, so I'm going to disregard this because sometimes at the open is a little bit of a fluke and things like that. So we'll just say right here, this is more realistic. So after 5 minutes after the market opens on Thursday, you're down 42% or $350 per contract. Ultimately, this is again here on this day and this time. Ultimately, you end up being right. So by Friday, as the Qs actually hits your targets, you end up being up 23%, or you end up making $190. Now, what person will actually be able to hold down 42% just to end up getting a 20% target when this is the price action that we're seeing? The likelihood of a person holding this position is very slim. You're more than likely stopping out somewhere around here, which means you're taking a loss in this vicinity. And that's what's actually, again, hard when you're now trading options to remain consistent, because sometimes you'll be right, sometimes you'll get it, sometimes you'll mistime it, sometimes, other things will factor the trade, news catalysts, different things will come out, and then ultimately by expiration, or when you were saying it was going to happen, you're no longer part of the trade because you stopped out, or you change biases, which is even worse. You start buying calls as this is happening because now the market looks all super bullish. And this right here, this choppy price action will drive you nuts, which is why I tend to disregard a lot of this. I try to have some sort of a game plan, and then it's all about building up my conviction and then staying in the trade if I have to balance it out with some hedges and things like that. But more importantly, structuring the trades in that I'm never taking on this type of risk for a trade that I have conviction of, or that we're heading in that direction. So now what's the alternative? Let's take a look at a put calendar spread. And this is the one in which we actually took. So let's just keep it, let's change it again back to the area so we can see the P&L, right? Cleaner. So this is the day position is opened right here. As I move my mouse, you can see that the crosshairs are synchronized. So now we're talking about buying a spread for $2.19. Max drawdown the next day was only 11%, so down $22 per one purchase. So if you put $1,000 in this and you bought, we'll say, I'm averaging everything, of course. So say you got 5 of these, you're hardly down 150. You're down less than $200, right? You're able to stomach and hold this. On top of this, this calendar was actually going for the following. So let's actually show you guys what it looks like on OptionStrat right here. So this is the actual calendar. Again, we're now flat this position. At least I went flat on Friday. I don't know if anyone's still holding. But what this is saying is this is the contract, the expiration in which we're shorting. So that's the 11th right here. This is the strike price. Again, 335 is where I thought the Qs would pull back to. And this is the put contract in which we're purchasing for further out dates. So it's about 7 days between the two. So 7 days until expiration. At the time when we purchased this, it was going for $2.19. If we take a look at the historical chart right here, we can see the same information. So on this day is when it was purchased for $2.19, and then we can see it kind of just slightly pulled back before ultimately increasing in value. If we take a look at the Greeks, we can see the same thing: a negative delta, positive theta, positive vega. So I mentioned something. I ended up mentioning something like this in the Discord to this trader here who's new to this types of spread. So it's like, the Qs were up 2.5% from when we opened the trade. So if we take a look right here, which we opened it, let's just actually measure that out. So from here to here, the Qs were actually up all the way up to here, 2.5%. So actually we'll say from here to here, we'll use a little bit of the averages again, 2 to 2.5%, right? The Qs were up about 2.5% from when we put on the bearish position, but yet the spread was only down about 1.5 to 2%. If the Qs were actually down 2.5%, we'd be up a lot more than what we're risking. So in other words, if the market catches everyone off guard and we ended up dropping, we would end up actually being up over 40% in a couple of days. And that's just because, again, whenever the market pulls back, the implied volatility increases, time is also passing by, and we have a delta position. So what ends up happening is you get a nice explosion in these calendars. Now, this was a very safe one because it actually expired the following Friday. So it wasn't even a weekly calendar, but you guys can see this. There's almost no way to hold the naked puts through this type of pain, but you're not really experiencing much pain. And now we're talking about being down 22 cents to ending up being up over 60 cents on the contract. So risking 20 bucks to make 60, right? And this is when you're wrong. Again, we looked at the example on the SPY in which we didn't really end up with any pain because we were essentially right from the moment we entered it. And now we're talking about an entire index moving completely against us for a whole day. And you're not really even concerned because even on Wednesday right here, this is what we're seeing. It's not really, a drop in your P&L being that devastating. I'm pretty sure if you're down, 10 cents a contract, so 10 bucks per contract, if you're in 10 of these, you're only down 100 bucks as the market is going against you. And then it goes even more against you. Now you're only down 200 bucks, and all it takes is one day and then another day for you to actually hit your target. And with 10 of these, that's a $600 trade. Your max drawdown was 220 bucks. So being down 220 to being up over 600 because you had such high odds in your favor, it just required a little bit of a bias in terms of your directional bias. And you can use these for at the money spreads and non-directional spreads. But again, I want to talk about if you're taking directional trades, which means you think something is going down or you think something's going up, and trying to present you guys a safer alternative that you can increase your success rate because you'll be able to stay in these trades a little bit longer because you have more conviction behind the trade, but also because your risk is not as high and your Greeks are actually going to work in your favor when you're putting on the spread. Now, if we jump to if you were really as I had enough conviction in the SPY to go with such a short-term calendar, but let's just say you were to do the same one, and this time you were using a calendar that expired on Friday, which means you were short the 335 put for Friday, and then you were long the 335 put for the following expiration. So this upcoming Friday, so 311. Is the put you're long, and then the put you're short is 3-4, which was again this Friday right here. Look at how this one worked out. So your entry same time here would be going for $2.60, and the max drawdown on this contract you'd be down was 37 cents per contract, so only down 14%. However, again, this entire day you're only down 14%. You can stay in this trade. It expires until Friday, and let's just say you decided to just hold it for one more day or overnight. As the market opens, you're not experiencing any more drawdown. This is your max drawdown. Again, negative 14%. By the time the market hits your targets, you're up 125% or $323 per contract purchase. Imagine the same thing. If you had just $1,000 in this, so you'd be in about 4 of these. That's 4 times $324. Obviously, you would scale out. So probably around here, why take the overnight risk? You might as well just take some profit off right here, take some profit right off here at the open, and then take some profit once your target was actually hit. If we were to turn this back onto the candlesticks, we can actually just see what it looked like. Again, usually the Thinkorswim is not showing the exact levels because there's a lot of fluctuations whenever you're looking at your P&L with these spreads sometimes, because there's a spread between the bid and the ask. and sometimes it's a little bit wide, and at certain times the fluctuation kind of throws off what the chart is going to tell you, but usually it's not accurate. So when you see spikes like this isn't necessarily realistic to get filled up here, especially, or also if you see like these spikes down below, that's not really what's happening, which is why most people are not really looking at the chart for the spread. It's just convenient that Thinkorswim allows us to be able to do this, and it's perfect for me whenever I'm showing you guys these examples in videos. I like the way OptionStrat actually displays it right here and smoothens the curve, so you guys can see it's nice and clean and smooth like that. So hopefully this shows you guys some sort of an alternative for two scenarios: one in which we were right very short term, another scenario in which we were wrong for a whole day but was not worried at all, was able to hold this, and we actually hit our target. And nothing is sweeter, guys. I could tell you, like, this is one of the sweetest things when you're trading, to see that you're saying 3-4 days in advance this is where something's going to go, and then it goes exactly to that level, and that's exactly where it stops, and you were able to stay in the trade for the whole time and take profit right at your level. And at the same time, you never had much risk on the table. Meanwhile, there are people out there that are trying to trade these types of options, dealing with all sorts of pain and a lot of compulsive, erratic behavior it's happening in the market right now, because there's so many traders and there's so many day traders and scalpers and people buying these inflated premiums, and they know it's a very dangerous time to be putting much risk on, but they can't help it because of gambling tendencies, because of the addiction of trading or chasing or trying to be the next big, social media options trader guy that can make $2 billion in 2 seconds, risking everything that he owns. And it's creating this environment that's making it very dangerous to actually trade, especially for newcomers. And then in a few months, I think it's a Q3 or Q4, if you haven't heard about, SIBO is actually going to introduce OPEX, so options expirations on the indexes, on the SPY. I don't remember if on the Qs also, every day of the week. So Monday through Friday, there'll be 0-day options. Imagine what that's going to do to the market. It means we're going to see a lot more craziness, a lot more spikes and random transactions happening all day. And this is why, if you take the time to really understand and learn this, you can swing trade during this type of environment and try to put a lot more odds in your favor and have smooth P&L curves and be able to stay in trades and kind of be a lot more and create a lot less of a stressful trading environment for yourself, and then have a lot more time to do other things during the day, because you can actually swing trade. You can just scale in, build into big positions. These are the type of positions where you can comfortably put $1,000. Even if you have a 5K account, you can put $1,000 in these types of trades, because your risk is only going to be at most maybe 30%. So you're probably risking $300. And then if you're right, you're talking about getting a $900 return out of it. You can actually come up with a concrete business plan saying you risk 3-to-1 whenever you run these type of trades. And not to mention, you can still trade the 0-day options if you need to protect the calendar. So let's just say you would enter the put calendar on this day for Friday, but then the next day you have reasons to be long. This is a Wednesday, so there's 0-day options. You can buy maybe a naked call and just trade that naked call, that one naked call the day of, probably put up $150 on that one day, because you're down $150 on your $1,000 position. But these two cancel out, so you realize this gain on this day, and then you continue to hold your main position as the market pulls back. That's even sweeter when you experience that. Links to everything in which I've mentioned is in the description down below, guys. Link to my Discord is also in the description, as well as link to the Quant Trading app website is also in the description. If you have any questions about it, feel free to join the Discord and you can ask some questions there. Catch you guys in the next one.